Hello everyone, welcome to this first asynchronous lecture. Let me start by apologizing for the delay. You were supposed to receive this course material on Monday, and yet here we are. So sorry about that. The reason for the delay is because I was sick this weekend and yesterday, and I planned to prepare this material during the weekend and I could not. So sorry about that. Well, this asynchronous lecture covers some sections of Chapter 2 on GDP and CPI, which are two very important economic aggregates, if not the most important two aggregates. We were supposed to cover sections 3 to 5, but given that we are a bit behind schedule, because I'm kind of slow, sorry about that, today we will be covering sections 2 to 4 instead of 3 to 5. So let's start with section 2. Maybe you remember from section 1 on the economic circuit that we were able to identify 2 or even 3 methods to compute GDP just by observing the economic circuit. In this section 2, we will be addressing these 3 methods a bit more in detail with a few examples, with exercises that you can practice. So let me start by introducing national accounts or national accounting, which is a system, an accounting system used to measure various income and production aggregates, including GDP. So federal in Switzerland, this is the Federal Statistical Office, but statistical offices all around the world rely on these national accounts to compute GDP and other aggregates. You can find a gigantic database on the website of the IMF, the International Monetary Fund, or the World Bank, which they have data for almost all countries. So why do we need these measures? Because we want to assess the performance of an economy. We want to understand how the economy works, and we want to evaluate, assess its performance, and compare it over time and between country also. So we need measures to do this assessing work. So that's why national accounts came to existence. Just a side note, it's not a double entry bookkeeping system, as you may already know from standard accounting, financial accounting class. This is a single entry bookkeeping system, but this is not very important. Yeah, so gross domestic product, as you know, is the primary aggregate in the national accounts. It's the most important one by now. And as you also know, it's a measure of a country's economic output. In other words, it measures the production of goods and services within the economy. Very shortly, let us look at the definition of GDP, each of these letters. So P stands for product, which means that real GDP measures all the final goods and services produced in a country. So it has to do with the products that are produced. The term domestic means that GDP measures only the goods and services that are produced in the country, so inside the territory of the country, regardless of the nationality of the factors who produce them. So regardless of if the workers are from a neighboring country or if the capital that is invested comes from a foreign country. We will see the difference between gross domestic product and gross national product. In the second case, what is important is the nationality of the factors, be it workers or the capital. And we will see that for some countries, for small countries usually, there can be a big difference between GDP and GNP, gross national product. This is typically the case of Luxembourg, as we will see later. And finally, the term gross means that it's not net. It means that it's about investment term, the investment I. So investment is made up of net investment, so the new investment capacities in the economy, and also replacement investment. For instance, let's take EHL, the campus got bigger. There were some construction work to make the campus bigger. So it's actually a net investment because we are adding new production capacities in the economy. On the other hand, if EHL just was repairing or replacing already existing facilities, it would be accounted under replacement investment. And the term gross means that we take both into account, net investment and replacement investment. But this is not so important. Let's have another look at the world economy. So as you remember, GDP gives an idea about the size of the economy, and the size of the economy gives you a good indication of your influence in the world. While if you divide the GDP by the number of inhabitants, you get a better idea not of the influence of the economy in the world, but of the standard of living within the country. So as you can see, Switzerland, maybe for instance, Switzerland is relatively small economy in size worldwide. But then if you would divide this GDP, total GDP by the number of inhabitants, it would result in a relatively very high standard of living. So here we have the United States is still the biggest economy and China is behind, but as is written here, by 2030, China's GDP is projected to surpass that of the US. So it's expected that within the next 10 years or less, China will be the biggest economy in the world. I remember a question from class that was interesting about Russia. Some student noticed that Russia was kind of small, and yet Russia is still very influential in the world. So if you see, Russia is smaller than Italy, it's a bit more like Spain in size, but in the world it's much more influential than Spain and Italy. Yes, this is true. This is because Russia has many raw materials that are needed in the supply chain, that are needed worldwide to produce goods and services. So that's why they're so important. They are so influential in the world economy. So Russia's GDP does not reflect Russia's influence in the world, while Switzerland has kind of important GDP, but has basically very, very low influence in the world because we have no raw materials or strategic commodities. So the three methods of measuring GDP, you may already know them, or you remember from section 1. There are these three different methods. So the production method, which is simply the value, the market value of final goods and services produced in the economy. Or equivalently, we can also compute the added value of all firms or all sector in the economy. This is equivalent. You will understand the difference very soon. Another method is the income method, which is actually very easy. It's just adding up all incomes paid to the factors in the economy, and the factors are labor and capital. And finally, the expenditure method. So in theory, the three methods lead to the same result because we study the same object. What's different is simply that we study this object from a different perspective. Once from the production perspective, another time from the income perspective, and another time from what has been from the expenses, from the expenditures. So in theory, we could use any one of these three and get to obtain the same result. This is what is done actually. If you check into federal statistical offices around the world, they would usually give you the GDP calculated according to these three methods and end up with the same result. Well, actually, in practice, it's not so easy to get the same result because GDP is a statistical measure. It's not as easy as when you observe the economic circuit, and you just have to add all the values. Here you have to estimate. In real life, you have to estimate the expenditures, you have to estimate the profits, you have to estimate added value. And in the end, you would not get the exact same result for the three methods, but then the statistical offices around the world are adjusting these results so that they match. But it's a complicated process, and yeah, it's kind of slow, complicated, and subject to revision. Sometimes GDP is calculated. You can in the news, journalists are reporting about the growth of the GDP compared to last year or last month. But then later, this number can be revised because we forgot something or something was poorly estimated, etc. So in practice, it's not very easy, but in theory, it's very, very easy. So the production or added value methods is simply this way. So the GDP is equal to all added values in the economy. And what do we mean by added value? It's the increase in the value of products resulting from the production process. So in other words, for if we take a firm, for instance, we can calculate the added value of a single firm by taking the production value, so the market value of what it has produced, and we would deduct all intermediate consumptions that the firm has used in the production process. And intermediate consumptions is defined by all the inputs, all the goods and services required for the production of the firm. So as you see, intermediate consumptions, it deals only with goods and services that are needed to produce what the firm is producing. We do not take into account here labor, for instance, or capital services. It's just about the goods and services that are required for production. Well, we need to do this to deduct these intermediate consumptions, because if we would simply add all the production values of all firms in the economy, we would be double counting the productions that require intermediate goods. And as a consequence, GDP would be greatly overestimated. Let's have well, and then in the end, the sum of all added values is equal to the value of all final goods and services that are produced in the economy. So either you take the production value of all final goods and services, which is easy, but you have to identify which goods are final and which goods are intermediate goods. For instance, a car, a computer, a pen, all these goods are final goods. But yeah, for instance, raw materials are intermediate goods typically. So the value of total production of final goods is equivalent to calculating the added value of all goods and services produced in the economy. So this is equivalent. You can choose one or the other. Let's have a look on the real world. In the real world, and in the case of Switzerland, if we divide the economy in three sectors, so the primary sector deals with raw material, extracting raw materials or agricultural productions. The secondary sector is the sector that works with these raw materials, produce stuff with these raw materials, and the tertiary sector produces services. So we start from 1995 and we compare the added value, the growth rate of the added value in each of these sectors. And we can see that the primary sector, the added value has been decreasing and has remained at very much lower level than it was in 1995 in Switzerland, right? while in the same time, at the same time, the tertiary sector has exhibited a very high growth in added value, and the secondary sector is between. So it means that productivity has very much increased in the tertiary sector. Its productivity has increased a little bit in the secondary sector, and productivity has kind of declined in the primary sector. The tertiary sector in Switzerland is typically financial services, um, insurance services, advice, tax advisory, or pharmaceutical laboratories, pharmaceutical analysis, stuff like that. While the secondary sector is the manufacturing industry of machines, of watches, stuff like that. And the primary sector is the agricultural sector, mostly in Switzerland. This is a small exercise to calculate the added value of a small business. So in the first question here, you will only have to apply the formula of the added value that we've seen in the 2 slides earlier. So it's the production value minus the intermediate consumptions. And intermediate consumptions means goods and services that are used in the production process. So you can calculate this and then divide, because we want the added value per biscuit, and you can divide by the number of biscuits. It's 200 units. And in the second part of the exercise, you have to calculate the total income that is generated by this production. This income is distributed between wages and profits. You have the answers in a file called solutions to in-class exercises, because we were supposed to do that in class, but you have the solutions in this file on LMS. The conclusion of this exercise is simply to notice, to make clear, to emphasize the fact that if you calculate the added value or the total income, you will get the same result in the end, because we are talking about the same things. It's just the perspective that changes. So maybe I let you pause the video and try to solve this exercise, and then you can compare your answers with the solutions sheet. All right, let's move on. So the first method was the added value method, or the production method. Now let's move to the second method, which is the income method. The income method is very easy. It simply involves adding all income distributed to the factors of production. And you know there are two types of factors, two factors of production, which is labor and capital. And labor income are wages, bonuses, income from self-employment, etc. And capital income are interest, dividends, rents, etc. So the income method is very easy, right? Let's have a look at some data, and we can compare the share of wage income and of profits in GDP. So this is a kind of complex graph made by Citibank, an American bank, very well known. And this is about this is on the case of Australia. So these data are concerned with Australia. But we would observe the same trends in most advanced economies around the world. So let's have a look at this graph shortly, right? So let's take first the red line here. The red line gives us the share of profits in the economy. So if you come back, it's a capital income and it's mostly dividends, so the profits that are paid to shareholders. So let's take in the 1970s. So here, the share of profits paid to shareholder in total GDP was around 16%. This is the right-hand scale here. And this share of profit in GDP constantly increased since the 1970s until today. In 2019, this share reached more than 30% of GDP. So 30% of total income, or 30% of GDP, is distributed to shareholders in profits, is distributed as profits. And this share has constantly been increasing over the last 50 years. In contrast, if we look at the blue line, which is the wage share of GDP, so in total income paid to factors, wage is a very important element, but the share of wage has constantly been decreased. Well, not constantly, but on the trend is that it decreases over the last 50 years. So this is the wages is on the left-hand scale here. So in the 1970s, it reached until up to 62 or even more 63% of GDP. 63% of total income generated in the economy was distributed to workers in the form of wages. That's how we would name this. But today it's more like here the blue line is more, it's below 50%. So we went from 62 to below 50%. Yeah, so we have an increasing share of profits and a decreasing share of wages in the economy. That's what we observe. And the reason for that is mostly financial liberalization, which occurs in the 1970s, 1980s, where finance got more important in the working of the economy. Finance nowadays plays a major role in the working of the economy. Sometimes some economists would argue, even at the IMF, that finance is too big for the economy. But that's how things are nowadays. That's the trend we've been observing this past 50 years, actually. All right. Let's have another look at something different here. This is again the labor income, in the share of labor income in GDP. How it has developed between 1995 and 2013. So let's take the example of USA, for instance. So in the US, between 1995 and 2013, the share of labor income in GDP has decreased by around 7-8%. In Korea, it's even more. The share of labor income has decreased by almost 13 or 14%. This suggests that the profit share of income in GDP has increased in these countries. On the other side, we have Italy or Great Britain, where the labor income in GDP has increased, which would suggest that some other components of total income have decreased. Typically, the share of profits has decreased. So there are very important differences between countries, okay? Now let's have a look at these very easy exercises where you are asked to calculate the GDP according to the three methods: the production of final goods, the value added, and the income distributed to factors. Here we are ignoring the expenditure methods. So yeah, so you also, for this exercise, you have the answers on the answer sheet, the file named called solutions to in-class exercises. You have the solutions there. Feel free to please compare your results with solutions provided there. But it's a very easy exercise. For instance, let's take this is representation of the French economy, of course, a very simplified representation of the French economy, which would be made up only of three companies, which are these three companies here: France Oil Limited, France Steel Limited, and Citroën, the car manufacturer. And we want to calculate France GDP according to these three methods: the production of final goods. So in this case, the final good is the car, because France Ore Limited is a mining industry extracting ore, actually, which is a raw material. France Steel Limited is making steel out of the ore, so it's not producing a final good. It's only producing intermediate goods. The only firm producing final goods is Citroën, which is producing cars, and the market value of these cars is 21,500 euros. So that would be GDP's value according to the production of final goods methods. Now, if you would calculate this according to the value added at each state of production, you would calculate the value added by each firm. So let's take France Ore. France Ore is extracting raw material, so it doesn't consume any intermediate goods, and the sales value, the production value is 4,200. So which means that the value added by this company is simply the sales value. For France Steel, it's a bit different. The sales value is 9,000 euro, but you need to deduct the consumption of intermediate goods. Here, this company, France Steel, has consumed the ore produced by France Ore Limited. So the added value is simply 9,000 minus 4,200. Sorry. And for Citroën, you would do the same. You would calculate the added value in the same way. So production value 21,500 minus all intermediate consumption. So here it's 9,000. In the end, you would end up with the same result as for the production approach. And you can also have a look at the income approach, the income method. So you would simply sum up all income distributed to factors, and these income are wages. So we sum up all the wages. You would also sum all the factors paid to capital. These three categories here are the income paid to capital. So you would simply sum up all the rows here, and in the end, you would get the same result. So we will find GDP. You can find the same value of GDP, of France GDP, by using any of these three methods. Please pause the video and try to do that yourself. It's very easy, but it's just so that you get used to this, to the fact that really these three methods are actually calculating the same thing, but from a different perspective.